Hey, Happy New Year. It would not be normal if I didn't have a little bit of technical difficulties. Hey, welcome to another Mortgage Minute. It is 2024 and you are in the right place. If you have questions about, hey, should I refinance my house? Should I get a HELOC? What are the rates? You're in the right place. And we have the expert who can answer all those questions and more with Art Alvarez. Let's bring him in the studio. Hey, Art.
Hey, Jeff, how are you? Happy
Good.
New Year.
Thank you. And you too. You have a good one?
I did. It was kind of quiet, but it was a good New Year, good holiday all around. So, and I had technical difficulties this morning as well. So, or this afternoon, I should say.
It must be in the air that says, hey, we should still be on holiday instead of working, maybe.
Right. Exactly. Yeah.
Well, let's see. I know there's a lot of good things going on. I hear all kinds of rumblings about rate cuts here and there and the Fed's meeting and things like that. But you know what I've learned from you is don't trust the headlines. Don't trust those headlines. What is underneath there in maybe paragraph 7 is most important. So I'd like to turn it over to you. But before we do, hey, I'd like to remind people, if you're just joining us or you're here live, this is a live show and Art will take your questions. Just put them in the comments. I'll be behind the scenes sending those over so Art can answer those. And if you're watching this afterwards, just please, again, put them in the comments, whether you're watching on Facebook or YouTube. Yeah, Facebook or YouTube. If you have a FaceTube, let me know about that. Anyway, just put those in there with Art. With that, I'll step away. Have a great show.
Thanks, Jeff. Well, hello, everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Happy New Year. Welcome to this year's first Mortgage Minute. So let's jump right into it. As you know, we usually like to talk a little bit about interest rates and the bond market to start with. So let's go ahead and do that. Just to remind you that you can check where current rates are on our website, on our rate grid. It's right there on the homepage. Jeff's got it up here now. And you can see that rates are still holding in there pretty well. But as Jeff just alluded to, the last few weeks, maybe the last month or so, has been pretty interesting as to headlines related to mortgage rates and so forth, because there's been a lot of headlines describing that mortgage rates have plummeted, that they're just dropping like a rock. And that's been somewhat the case. I think I pointed out before that we simply had gotten back to rates that were in effect in May and June, when at that time rates at these levels were not considered so great, but now they are. So it's all about perspective, because of course, not too long ago in October when we were approaching 8%, we never did. We were in the low 7s. Obviously, if we're now in the low 6s, and that's a good improvement. Whether or not I'd call it plummeting, I'm not so sure. And part of where we're at right now is actually about a 0.25% increase over where we were about a week to 10 days ago. And why is that? Well, Jeff's going to pull up the 10-year bond yield chart where you can see what's going on. Not too long ago, in fact, here you can see for the last 5 days, going back to last Friday before the New Year holiday, the bond yield was quite a bit lower. In fact, at one point in late December, the 10-year bond yield actually got down to around 3.75. Which is very good. Well, now you can see we're back up to about 4%. So as a consequence, mortgage rates have moved in a similar fashion, and we're now looking at about a 4% 10-year bond. And now mortgage rates, conforming loans in particular, when a couple of weeks ago we were at right around 6, now we're about 6.25. So again, that follows or tracks to the 10-year bond. So what's going on in that regard? What's happening in the financial markets to cause this kind of move? Well, there's a couple of things. First, I'll point out that the improvement that we saw in December with bond yields had a lot to do with the Fed's last policy meeting of the year in December, where the minutes actually just came out earlier this week, where it was apparent that the Fed officials have agreed that interest rates have likely peaked. So that did give the bond market some assurance that maybe we're past the worst of it as it relates to rates going up further, despite what we're seeing today with the bond yield getting close to 4%. The other thing that happened this week, because we were actually touching 4% on Tuesday, you can see that on the chart, and then we had this dip yesterday. So what was going on there? Well, yesterday was the release of the JOLT report. Remember, JOLT is the job openings and labor turnover. And the JOLT report had new job openings for December at about 8.7 million. That was or is a 32-month low. So that's an indication that things are okay with the labor market, but maybe not great. Also, what came out on yesterday was the ISM Manufacturing Index. It shrank. It has now shrunk for 14 straight months, ending in December. So those two numbers, those two data points helped get us away from that 4% bond yield yesterday that was there on Tuesday. We were actually down to about 390 yesterday, but now we're back up to 4 today. What happened today, which is not actually on the slide, is we had initial claims from unemployment come out today, and it was lower than expected. So less people applied for unemployment benefits than was expected. That's an indication that the labor market is strengthening. So you get these cross signals about the labor market, and overall the labor market, I would say, is the primary focus on where rates are going to go and where the bond yields are going to go. The next data points coming out are not till tomorrow. That's the employment report and the unemployment rate. New jobs are forecast to be 170,000. That would be down from 199,000. So if new jobs turn out to be higher than 170, probably a watch out for. That would probably suggest the bond yield could get worse even from the 4% level we're at right now. The unemployment rate is forecast at 3.8%, actually an increase from November. So if that proves to be true or ends up even being a little bit higher, and if the new job forecast turns out to be a miss on the downside, meaning new jobs are lower than 170,000, that might give us reason to cheer a little bit, and we might see the bond yields come back down. So overall, though, what I want to point out is that, as Jeff mentioned again earlier about headlines, yes, mortgage rates did improve nicely in December. Plummet, I'm not sure I would use that adjective. They did improve nicely, but we're still pretty solidly in a 6% plus level. I would argue that's not bad. That's pretty normal historically. And I think we are seeing some signs that more and more folks are realizing we are where we are and you got to move on. And if home ownership is in your future, I think you're better off to look at that sooner than later. Because the other thing, by the way, that came out recently was home prices. October, home prices nationally rose year over year about 4%. So home prices nationally anyway, some markets are different, are still going up. And if rates do improve any further, if we get into the 5s and certainly in the 4s, yes, more inventory will probably occur, homes for sale that is, but there's so much pent up demand, as I say all the time, I think that'll overwhelm that increased inventory, and home values, I think, will go up even further. So if you can figure out a way, and we can help you with this, qualify to purchase a home now, qualify for the financing, I think you're better off doing it now. Don't wait. Don't try to time the market. Get home ownership now, and then as rates fall, you'll have two benefits. One is you'll see some increase in your equity, I predict. That's my prediction. And you'll have that opportunity to refinance into a lower note rate later. So keep that in mind as you contemplate when you want to take a stab at getting into a home. With that, we're going to go ahead and go on to the next slide. And this is really triggered by something that I caught my eye on the financial news recently. So what I want to talk about a little bit here is equity loans, in particular, first lien HELOCs. And the reason I want to bring this up is because I saw an article where, as it turns out, both nationally and in California, the number of homes that are free and clear is remarkably high. But before I get to that, let's at least talk about HELOCs just as a reminder. Most HELOCs, and again, a HELOC, home equity line of credit, in most cases, they're a junior lien. They're going to be put behind an existing first mortgage. So a HELOC is a second mortgage. I've had some homeowners, debate that with me. They didn't realize that a HELOC is a second mortgage, but it is. It is secured by your home. But the reason I wanted to talk about first lien HELOCs is because there is now a record share of U.S. homes that are mortgage-free compared to any time since 2005. The share, the share of mortgage-free homes jumped from 34% to nearly 40% in the past decade. I mean, that shocks me, and I'm in the business. In fact, California is the state with the third highest number of mortgage-free homes at 2.4 million. So again, third highest among the states. So what that suggests is when you have that many homes that are free and clear, a lot of those homeowners would like to tap into that equity. They might not be thinking about a HELOC, maybe because they already are thinking that HELOCs are second mortgages, which in most cases they are. But you can get a HELOC and have it record as your only mortgage, as a first mortgage. And the reason why that might be a good idea to consider is a couple things. Excuse me. One is first lien HELOCs, the closing costs, if you're going to get one, are much lower than getting a traditional first mortgage cash out refi. For example, if you're going to get a HELOC up to a $250,000 line amount, you don't have to get title insurance, and that can save you several $100s. And then the other costs associated with HELOCs, generally speaking, are going to be quite a bit lower in terms of escrow fee and so forth. So I just want you to be aware of that. It's a very good option to consider if your home is free and clear and you want to tap into that equity. Now, if you're a senior homeowner over 62, then the competing product to consider is a reverse mortgage, which, as we talked about in our last program, can also provide a line of credit feature as well. But if you're under 62, if you're not eligible for a reverse mortgage, a first lien HELOC can be a great option. And now there are minimum draw requirements on a HELOC, and and there are going to be rates that are higher than on a HELOC. Again, HELOC is tied to the prime rate. Prime rate is 8.5%. By the way, it's been that way since July of last year. So again, in terms of the Fed funds rate, HELOC rates, they have been stable now for going on 7-8 months. So yeah, the rate is higher than if you're getting a first mortgage refinance, but it can be a great alternative still, even with that higher rate. When you get the HELOC, you typically, if you don't need all that money right away, you still have to take a minimum draw. With many lenders, it's about $50,000. What I tell my customers is get the loan. You'll have to take that draw. When you start getting your monthly payment statements, just send the money back, or at least most of it. And then that pays down the balance. Then your monthly payment is going to be reduced because it's based on the outstanding balance. And then you still have that available for your use, in most cases, for up to 10 years. That way, and then the other point to understand about getting a first lien HELOC, if your home is free and clear, the Fed is being viewed to be looking at lowering the Fed funds rate. Predictions are 3 times, maybe more. And with a HELOC, it's going to react immediately to those changes. So even though the Fed funds rate right now is at 8.5, if you get a HELOC now, I think you can expect that rate on the HELOC is going to be going down in 2024 as the Fed starts to lower the Fed funds rate. Of course, that will narrow the spread between where a HELOC rate is and where first mortgage rates are. So overall, I just want to remind you that if you have a home free and clear, or if you know someone who does, and they want to tap into that equity, they can still get a HELOC. It can be a first mortgage, and it can be a terrific, as I put in the slide, a terrific rainy day fund, if you will, to access money quickly when you need it. So I just wanted to point that out. In particular, given learning this interesting data point that millions of homes in California as well as nationwide are actually free and clear. 40% of the housing stock is free and clear of a mortgage. That's a surprising number, and I think those homeowners just needed to be reminded that a first lien HELOC could be a good option for you. So with that, we're going to bring Jeff back in. We have a question that we got recently about credit report fees. And I wanted to, answer that question because there's some interesting going on with credit report fees in 2024.
Yeah, it came up. It says credit report fees. I saw a headline about mortgage credit report fees going up in 2024. What's that all about, Art? Can you shed some light on that?
Yeah, and it's really going to be a challenge. And talk about inflation. Well, there's, we still talk about inflation like with groceries and so forth, and inflation's coming down. One area where inflation doesn't appear to be coming down is the cost of getting a credit report when you're getting a mortgage. Not too many years ago, I'd say probably 2, 3, 4 years ago, when we pull a credit report. Now, in that regard, what we have to pull for a mortgage is what's called a 3-bureau in-file merge report. So it's going to collect data from all 3 bureaus, Experian, Equifax, and TransUnion. And then it merges that data into one report. Now, again, 2, 3, 4 years ago, when we would have to pull one for a new loan file, the cost of that report was, in most cases, under $30. But that's been going up. You may recall last year, beginning of 23, the cost of the credit reports that we have to obtain went up dramatically by about 80%. And in fact, by that point, beginning of 23, the cost of a 3-bureau in-file merge had gone up from under $30 to about $35. But then, beginning of 23, the credit bureaus, again, Experian, Equifax, TransUnion, announced that there was going to be substantial increases in the fees associated with pulling those reports. And so for all of 23, a typical 3-bureau merged report for 2 borrowers, like typically a married couple, has been, for us anyway, from the vendor we pull our reports from, $74. Again, that's an increase from low $30 range in 2022. One of the things that we've been trying to do to deflect the cost of credit reports is we can also get what's called a soft pull report. And those were always much less expensive. Again, a year ago, when we were getting reports at $35, a soft pull report we could typically get for around $15, maybe $20 for, again, 2 borrowers. Now, what's happening is there's new increases that have been announced for both what we call hard pull, the 3-bureau merge report, as well as the soft pull, which is also a 3-bureau merge report. Now, that hard pull report is going to be in the neighborhood of about $85. And the other disappointing thing is that the soft pull reports, which used to be much less expensive, are now no longer going to be so. Now we're hearing that a soft pull report is going to be in the neighborhood of $60. Now, why that's really a challenge in the mortgage industry is because in a lot of cases, we're going to get inquiries to pre-qualified buyers. And in so doing that, we've got to obviously pull a credit report. In a lot of cases recently, certainly during 23, we would often try to, keep the cost down by pulling only a soft pull. That way we get all the debt accounts, we do get the credit scores, so we can effectively process a pre-qualification. And we would start with that. And the reason I bring that up is because in the pre-qual stage, we don't collect any money at all for doing the pre-qualification, including for the cost of the credit report. And when we do pre-qualifications, it's not 100% pull through. We're going to have some folks who may try, submitting several offers and they're not successful. They may decide they give up. They decide not to move forward with a purchase at all. We end up eating the cost. Or sometimes maybe, they'll decide that they, need to, basically move somewhere else and we don't keep them as a customer and so forth. So as a consequence, it's been a cost factor for mortgage originators that they know we're going to incur some cost for ordering credit reports on pre-qualifications where we're not going to actually have that turn into an application where we can then get reimbursed for that cost when we close the loan. Now and even with the soft pull strategy, one of the deficiencies of that is we would oftentimes have a real estate agent, tell us, okay, great, we got your pre-approval letter and it's got the credit score, that's great. But the seller wants what they call DU findings. That's desktop underwriting. Desktop underwriting, as a reminder, is a software tool used by Fannie Mae to basically render an initial approve eligible recommendation. Freddie Mac has a similar system called LP or LPA. And the problem when we get those kinds of requests is that we then have to pull a hard pull report. So we were getting more frequent situations where we've already spent money for a soft pull report, and now we're being asked to pull a hard pull report. And with the cost in 2023, we would very easily end up with over $100 in costs to pre-qualify a home buyer without the promise or the reassurance that we're definitely going to get a loan out of it, because there's all kinds of reasons why that borrower may not follow through and actually buy the house. So again, it's a cost we incur that we don't get reimbursed for because we never closed the loan. Well, now what's going to happen is if a hard pull is $85 and we're hearing a soft pull is going to be $60, well, a couple things. One is it almost diminishes the reason why we would do a soft pull, because the price variance is not sufficient enough. The soft pull is not low enough in cost for us to do that first, because of the risk we may have to get a hard pull anyway to get the automated underwriting findings. So we're probably going to use soft pull reports. Most originators, I would argue, probably will stop using them as much, and they're going to have to go with a full hard pull 3-bureau report. And the dilemma for us originators is that we're going to end up having to decide if we want to incur that much cost on the number of deals that will never happen, or do we have to go the next step, which I would really like to avoid doing, which is collecting an upfront fee from a prospective borrower who wants to be pre-qualified. We've never had to do that. And we've mentioned in past episodes, we as a company have never collected a deposit up front from a borrower when we initiate an application. Most lenders do, and it's typically a big number, like $500-$600. We've never done that, and that kind of deposit covers appraisal and credit report usually. So we have the dilemma of having to figure out, do we want to start collecting a deposit? We're not going to go to the $500 number. We just still believe that we don't want to do that, but we might have to consider collecting a small deposit, maybe $100, to defray the cost of pre-qualifying home buyers, on the assumption that in some cases we're never going to see the loan for a variety of reasons, and that way we're not out that cost. $100 for every time we touch a prospective borrower over time can add up to a lot of money. So that's what that viewer was seeing when they saw that headline about increased mortgage costs. It is getting the attention of certain participants in the industry. For example, Mortgage Bankers Association is pushing back on it. There are some calls for the FHFA, the Federal Housing Finance Agency, to look into this, because some of these increases they're not very transparent as to what's triggering these kinds of very significant increases. I mean, we're basically getting close to the point where the cost of a credit report is going to be more than 100% higher than it was a year or two ago. That shouldn't be happening unless we have some very good, clear reasons why. And so stay tuned and watch the news, because I think this is going to become more of a newsworthy item going forward. And that's why, by the way, when we do originate new loans, on the loan estimates that we have to provide initially, we're putting in much bigger estimated cost for a credit report. We're at 150 now. We may even go to 200 or 250, because in some cases, for example, if you're buying a new home that's under construction, and the builder wants you to apply for the loan and get approved right away, but the home may not be done for 6 or 8 months. I've got a deal right now. We started a year ago, March of last year. The home's not going to be done until March of this year. You end up having to update the file 2, maybe 3 times. We got to pull another report each time. Next thing you know, we've got over $200 in credit report costs. So if you're getting a loan and you happen to notice the credit report fee being disclosed at a much higher number, that's why it is. Jeff, back to you.
Wow, that's amazing, Art. The type of increase that you see in a digital product, because everything you're talking about is a digital. It spits it out digitally, correct?
Correct. Yes, exactly.
Yeah,
I mean, when we order a report, we actually get it like 30 seconds. I mean, it's that automated. So,
which tells me it's me being in technology is like, technology drives costs down, not up. Right. And so it makes me, I'm sorry, it just puts me in that wonder state of like, well, so they raise their prices and that's all profit. because the technology has to, unless you have just really, really old systems and they did some kind of capital expense to update everything and they're offsetting it, it should only go down, not up.
You would think so, right? And of course,
Yeah.
that's part of the issue right now that's causing some stir is that, FICO, for example, who's really the creator of credit scores to start with, they're not being particularly, transparent about, how much of these new fee structures they're keeping. The bureaus, they're not, they're arguing that they're keeping a pretty small portion. Then, of course, you've got the credit report vendors that all of us mortgage originators use to actually buy our reports from. We use a company called Cisco Credit out of Arizona. There's a multitude of credit report vendors, we call them, credit report essentially resellers. So there's the issue of how much of that fee are they keeping. Of course, they always point the finger. My vendor, Cisco Credit, they're pointing their finger at the bureaus, or they're pointing their fingers at FICO, saying, "Oh, it's not us." Somewhere in there, somebody's there's a lot of money being made, and I think that's going to come out. So,
wow, have you started to hear any pushback from borrowers yet with that?
Not yet, not too much. I really expected that in 2023 when we started putting 125, 150 as the estimated cost. Now, in most cases, we haven't hit that number. Again, on a joint report for a married couple, it's been running about $75, but you end up having to sometimes get a supplement to the report that ends up costing another $10 or $20. So in a few cases, we'll end up with closing a loan where the total credit report cost is over $100. I haven't had much pushback or comment on that from borrowers. I think that could start to change this year with these further increases that are being talked about.
Well, I think it's good to get ahead of the game here on the 4th of January and start putting this information out there as fresh. So when buyers come in, that there's not this sticker shock.
Right.
I think that that's something that's appreciated, that, that's something they need to have. Now, you said these are tri-merge credit reports.
Correct.
Are these things that the average consumer can request and bring into you, or is this something, it has to be done through the mortgage lender?
Yeah, the borrower cannot provide their credit report for use in a mortgage transaction, in part because, as I mentioned earlier, even if we're not asked by a real estate agent to provide automated underwriting findings at the pre-qualification stage, once the loan is originated, that loan application will be submitted through Fannie Mae's DU or Freddie Mac's LPA as part of this, basic process of getting your loan originated, underwritten, and closed. And as of now, that 3-bureau, tri-merge report has to be used for those automated underwriting systems. Those systems will not use a soft pull report. And those systems will not use a report that the borrower obtained independently and provided to the mortgage originator. So there's no way around that. We have to get that report because of the fundamental process now of using automated underwriting systems to get your loan approved and closed.
Last question. What's the shelf life of a credit report? And when you pull that credit report, you said something about, you might have to pull it 2 or 3 times to update the file. When you do a tri-merge or the 3-bureau credit report, how long is that actually good for?
A good question. Typically, in most cases, 120 days.
Okay.
Some loan programs, some lenders will have what we call overlays, where they'll pull that back and say, no, we want a new report after 90 days. So it's usually, in most cases, going to be somewhere between 90 and 120 days.
Wow.
Now, keep in mind, though, if you have a loan in process, one of the things lenders do for a loan in process, and again, this would come up quite often, for example, if you're buying a new home where there's a several month delivery period, the lender, even after your loan's been registered with them, we've gotten it submitted for underwriting, it's approved, basically you're just waiting for the home to get done, the lender is going to do backup credit monitoring. They do that with soft pull reports, so they can kind of check on what you're doing in terms of borrowing money while you're waiting for that home to get built. And if they do find evidence of new loans being obtained, we're going to hear from that lender, and we're going to have to go back to the borrower, have them explain what it's all about. If they got a new loan, they've got to provide us the documentation to show us the terms of the loan and the monthly payment.
Well, we'll have to keep an eye on this as we move forward, Art. Thank you for keeping us up to date. With that, I'm going to turn it over to last week's question.
Okay. Thanks, Jeff. Okay, folks. Well, now we're going to talk about the question that we had at our last episode in mid-December. Our closing question from, we call it last week, it was actually 2 weeks ago. We had a viewer ask us, the last time I applied for a mortgage, I had to explain a few deposits on my bank statement. My account showed plenty of funds to close the purchase, so why did the lender want to know more about my deposits? You know, when we saw this question, I kind of chuckled a little bit because it's a really good question. And from time to time, with some of the borrowers that I'm working with, they'll ask me this question. They'll say, hey, gee whiz, I got the money in the bank. Why do they care? Why, leave me alone. I don't want to explain all this stuff. It's none of their business. Well, unfortunately, it is their business. And there are some logical reasons why lenders do this. But first, let me kind of give you sort of what the standard rule is when it comes to large deposits. And I'm going to use, again, Fannie Mae as the source because they really are kind of the Bible of mortgage industry guidelines that most every mortgage lender relies on. Freddie Mac too, by the way. But Fannie Mae requires evaluating large deposits that are on your bank statements to determine if they are from an acceptable source. So that's the reasoning or the logic behind it. When you provide a monthly bank statement, or in a lot of cases you have to provide 2 months consecutive, the lender, the underwriting staff, they're going to go through those statements. They're going to look at your statement activity. Now, they don't really care where you buy your groceries from or what fast food places you get your burgers from or any of that. They're not paying attention to that. But they are going to be looking at certain things. And one of the key things they look at is your deposit activity. For one, they're going to look to see that the deposit activity is consistent with your job and the income you put on your application and what's on your pay stub. So they'll be looking for, obviously, things like payroll deposits. Those are fine, obviously. But they're going to be looking for any other deposits that are large that they can't tie to either your payroll or from any other source that they're aware of. And the definition of a large deposit is any deposit that's more than 50% of your qualifying income. So, for example, let's say your qualifying income is $6,000 a month. If they see a deposit into your account for $5,000 and that deposit is not adequately identified on the bank statement, like maybe it's an IRS refund or something of that nature, if they can't identify the source of that deposit, and because it's, in this case, over 80% or about 80% of your monthly qualifying income from your job, we're going to get an underwriting condition asking us to source and document, or actually explain and source that deposit. So we end up having to have our customers write an explanation. Who sent you the money? Why did they send it to you? And you typically have to provide some backup paper documentation to support the source of that deposit. And yes, it can be kind of a pain in the rear for some of our borrowers. So we do get some pushback on that from time to time. On this slide, I also provide some examples of unacceptable source of funds that the agencies are looking for. Personal unsecured loans. Those are generally not acceptable as a source for your down payment and closing costs. So if you go down to a finance company and borrow 10 grand and put it in your account for your down payment, that's part of why we have to ask for explanation of the source of that deposit. If they find out you got an unsecured loan, that money is going to be set aside and not considered for use as part of your down payment and closing costs. Cash on hand. In most cases, cash on hand is not going to be used. On isolated cases, it might be able to be used, but you've got to go through some hoops. You got to explain why you have cash at home. You have to basically demonstrate that you do not rely on banks at all, which is not very common anymore. There are some exceptions. For example, the Home Ready program through Fannie Mae, which is for first-time home buyers and is income restricted as to eligibility. That is a program that will consider cash on hand subject to certain conditions. And of course, on a purchase, one big no-no is your source of funds, either for your initial escrow deposit or for your funds for down payment and closing costs, cannot come from the seller. Well, actually, I shouldn't say closing costs, just down payment. Your initial escrow deposit and your down payment cannot come from the seller. The seller can give you a credit toward closing costs within certain limitations, but otherwise you cannot get cash from the seller to complete your purchase if you're doing that for purposes of your deposit, your initial deposit when escrow is opened, or for any portion of your down payment. So it's a good question. Hopefully this makes it more clear why we do have to bug you for that information when it occurs on your bank statement. It is pretty logical. And, when you think about it, it's a pretty reasonable thing for a lender to do because of these reasons. So with that, we'll go to the closing question for next week. This is also an interesting question we run into quite a bit. I'm looking to purchase a home and have student loans, but they're in deferment, which we see quite a bit of that. Yet I've been told that I'll still be considered. Yet I've been told they'll still be considered in my debt to income ratio. Why is that? So stay tuned for next week, where I'll have the answer to that question, and it'll be on the house. Jeff, back to you.
All right, great show. Good information. Way to start the new year on a very solid footing. And, I have one question, and it actually goes back to one of the beginning slides. I want to make sure I understood this right. It said all these homes that are free and clear went from 34 to 40%, which is a huge number when you consider it nationwide. And then I think on your notes, it said a third of California homes are free and clear.
Yes. Yeah, 2.4 million homes in California, which represents about a third of the housing stock in this state, are free and clear of a mortgage. And it was a surprising number to me, although I will point out, here where our office is located, our headquarters here in the Coachella Valley, cash transactions are very, very prominent. I've had real estate agents suggest to me that here in the Coachella Valley, cash purchases may be as much as 50 to 70% of the activity. I have a real estate agent in my networking group. Jeff, you know who she is. Mm-hmm. When I met with her a couple months ago, she told me that literally all but 2 of her transactions were cash transactions. There's an amazing amount of money out there. And so, yeah, that's what's driving the increase in homes that are free and clear is all that money that's out there. A lot of people are buying homes for cash, which is really interesting when you think about it, because you see the sort of the opposite news of so many people struggling to come up with a down payment to buy a home, and the housing market and the real estate market is soft because there's not enough people buying homes, and yet layer into that, a lot of the people buying homes are just writing a check. They don't need me. So,
well, that's a whole thing about this. Be wary of those headlines because, they are just there to get our attention. Art, as always, you give great information. The whole thing about it kind of caught my eye, but I was like, okay, he's just talking about a first lien. But then when he was a first lien HELOC, that was an interesting play. And now I understand for those people who have no debt on their home, how do they extract some money out of there instead of a cash refi? They don't want to put a new loan on there. So they do it with a cash out refi. And I love the idea where you said, hey, go ahead and do the minimum. And then what you don't need, send back. And it just goes back to, it's almost like a credit card. It goes back to the balance, doesn't it?
Well, exactly. It's basically, I've said before, it's a credit card secured by your house, essentially. So get the loan. Yeah, you have to take a draw. If you don't need all the money, send back what you don't need. Eventually, if you don't need most of it, maybe any of it, you'll end up sending it back within 2 or 3 months. And then what you've got is this big old credit card sitting there secured by your house. And if you need money in an emergency, you need it quickly, you just write a check.
I love it. Well, for those of you out there that are debt-free on your home, or you have some equity you want to get out, and you're thinking, how do I get it out? The number on the screen, 760-883-5700, is Art's office number. Of course, you can always call him on his cell. He has it on 24/7, 714-612-9035. You can get a hold of him there. And of course, always go to the website. You saw earlier on where it shows the rates. He keeps those updated. And there's a host of calculators and helpful tools on there to answer some of your questions. And of course, he's always available through his email at art@mwloan.com. Art, as always, you did a great job. I look forward to seeing you next week. I have something that I'm going to ask you off air. I hope we can talk about next week. I don't want to let that cat out of the bag in case I don't want to cause any riff here, but I want to ask you offline. Okay. All right. We'll see you next week, folks. Thank you.
All right. Thanks, Jeff. Thanks, everyone. Thanks for watching and listening. Stay tuned for next week's Mortgage Minute. I'm Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. So long. Take care.